Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, May 23rd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are NVIDIA beats, Fed minutes disappoint, and fresh evidence of our green shoots globally theme. The market implications there are NVIDIA's results are supportive of the continued outperformance of the quality and growth factors, which are likely to outperform throughout the duration of this business cycle. The Fed minutes are likely a red herring with respect to the near-term outlook for monetary policy, given the likely accelerated shelter disinflation in the coming months. We expect global equities to continue outperforming for another 1 to 2 quarters, but beyond that, the drivers are likely to be less supportive. Transitioning, as always, to our 42 Macro dashboard, wrapping up here with the question from our community. This one reads bias. So the question reads Goldilocks equals risk on with a disinflationary bias, correct? Reflation equals risk on with an inflationary bias, correct? Inflation equals risk off with an inflationary bias, correct? And deflation equals risk off with a disinflationary bias. It says, hi, Darius, please explain. So those are all correct. Hi, Darius, please explain what you mean by the phrases inflationary bias and disinflationary bias. So just said simply, inflationary bias just means we're talking about commodities and cyclicals tending to outperform, interest rates rising, versus disinflationary bias. We're talking about digital economy names typically outperforming with interest rates falling. Number two, how is the transition between the regimes determined? Is it sufficient to decide on the current market regime using inflation and growth indicators and to identify a shift in another regime using the same indicators? Absolutely not. That's a great question and something that we think is very important to take a second here to unpack. So we, part and parcel to our risk management process here at 42 Macro is helping our clients identify and position for the market regime. We use our fundamental research and our macro weather model to help them anticipate changes in the market regime, but we don't necessarily use our fundamental research and our macro weather model and our forward-looking views on what's likely to happen in the economy on our positioning. Our positioning is a function of what's happening in the markets so that we can maximize upside capture in bull markets and minimize downside capture in bear markets. There is a overall trend following element to our research and risk management process, and that's generally why our clients stay on the right side of market risk, because we are listening to and respecting the market as opposed to telling the market what it needs to do based on our predictions, which if you're an average investor or below average investor, your predictions suck. So let's just get it out there and say it, and don't shoot the messenger, but the facts are facts. So getting back into this question. So, in my prior life, I used to spend most of my time trying to identify what's happening in the economy and forcing those predictions onto our research or recommendations for positioning. What I found in this most recent business cycle was that one, the quality of predictions for not just ourselves, but for every investor, we've empirically tracked this, has gone down significantly, i.e. forecast dispersion has risen significantly across growth, cross inflation, and obviously across market expectations, none bigger than the investor consensus missing the entire run up in inflation and the resulting policy tightening, and investors missing the entire resiliency of the U.S. economy, and investors overly positioning for recession last year and missing out on that massive bull run. We got that's right, we didn't get the inflation thing right ex ante, but we got last year right ex ante. But anyway, getting back to this question here. So one of the things we've done in terms of evolving our process over time, because I think that's an important thing to do, because asset markets and the economy evolve. If your process doesn't evolve, you're going to struggle to consistently outperform over time. So one of the things we've done to evolve our process is to infuse trend following elements into our process vis-a-vis our proprietary volatility adjusted momentum signal. And the system that we use to identify to nowcast the market regime, which is our global macro risk matrix, really drive the volatility adjusted momentum signal is driving the changes in that system. So let me just give you a quick overview of how that system works here. So this is a snapshot of the 42 market indicators that are highlighted in our global macro risk matrix. Each of these 42 market indicators across the equity markets. Oops, sorry. Let me get my pen ready here. Sorry, not ready to write. Across the equity markets here, volatility markets, commodity markets, FX markets, and fixed income markets. And we're scoring each of these indicators from the perspective of our volatility adjusted momentum signal, and then scoring that signal on a daily basis relative to how the factor has historically traded in the particular regime. So for example, S&P 500, which remains bullish from the perspective of our volatility adjusted momentum signal, is currently assigning a point for today for both Goldilocks and reflation, because the S&P has historically been bullish in Goldilocks and reflation. And so we're doing that same process across each of these 42 macro market indicators. These are the 42 handpicked 42 markets that ourselves and our clients transact in on the institutional side. In our opinion, these are the most important market indicators to track in the world to identify what the market regime are. And every day we are scoring each of these indicators, again, from the perspective of their own volatility adjusted momentum signals, and then scoring those VAM signals relative to how the asset is historically traded. And then we summarize that here on the next slide. Currently, reflation has 25 of those 42 markets confirming it now. So we say it's the highest share of the total. So we say we are in a reflation regime. We've been in a reflation regime since late March, early April. And prior to that, we were in a Goldilocks regime from mid-November to late March and early April. So it's our job to identify this stuff in real time and then help clients proactively prepare and position their portfolios associated with the regimes. And we understand, based on back testing both the economy and asset markets, how the factors have historically performed across the 4 different regimes. And the big changes that need to occur in your portfolio occur when you go from a risk-on condition to a risk-off condition, or a risk-off condition to a risk-on condition, because that's typically when you factor leadership has this most significant change from a dispersion perspective. So that's a great question. Let me get back to wrapping it up here. Question number 3 is, the Fed is hawkish in the inflation regime. What is its reaction to the reflation regime? So, going back to the biases that were highlighted early in the table. So, in terms of you thinking about what's driving asset markets from a thematic standpoint across the 4 different regimes, specifically with respect to reflation in this question, reflation is a risk-on regime with an inflationary bias. What reflation is essentially trying to price in is nominal economic growth that is either accelerating or above expectations, or both, and the Fed and other policymakers like the Treasury are not doing anything to stop that. And the difference between reflation and inflation is those same economic conditions, i.e. nominal economic growth is either accelerating or perceived to be accelerating, or above consensus expectations, but the Fed and Treasury are now tightening policy to respond to that. So that's the difference between inflation and reflation. The difference between Goldilocks and deflation: Goldilocks is a situation where where real economic growth is perceived to be accelerating, is either perceived to be accelerating, or above expectations, and policymakers are either supporting that with policy or not doing anything to harm that. And deflation, lastly, is real economic growth perceived to be either perceived to be decelerating, or surprising to the downside relative to consensus expectations, and policymakers not doing enough to prevent that outcome. And so you think about this from a thematic standpoint. This is why we think about the world from a regime segmentation standpoint, because it's when you put those 4 regimes together, it's all encompassing, and it really does explain a tremendous amount of financial market performance on an absolute and relative basis across market cycles. And the consistency of the factor leadership across the regimes, across market cycles, is something that we can trust and hang our hats on as investors in terms of responding to changes in the market regime and repositioning our portfolios to stay on the right side of market risk, which fortuitously our clients have done that for the past few years because of this process, and we're really grateful for that. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, May 23rd, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.